The dollar's fatal curse, Triffin's dilemma. The US dollar reigns as the world's reserve currency, which sounds great, but what if this status is actually more of a curse than a blessing? Triffin's dilemma reveals the dark side of this reserve status. The very reliance on the dollar that provides global stability also fuels dangerous deficits and economic vulnerabilities. Is the dollar's dominance a ticket to prosperity or a ticking time bomb? Let's look at the real story behind the dollar's reserve currency status. So I believe that we are in the midst of a once in a generation sort of event. Triffin's dilemma is an attempt to explain kind of the global financial system. So this might seem complicated, but I will do my best to break it down in a simple way that everyone can understand. These are the sort of things you only see once in a generation, and I've been kind of down this rabbit hole for about a year and a half. I've written extensively about all these concepts. So if you want a kind of a written format to learn about some of these things, go check that out. And finally, I would say, this is something that, it went from being kind of a fringe conspiracy theory sort of thing, a year ago when I started talking about this stuff to now, very mainstream sort of discourse. You see it talked about on CNBC and Bloomberg TV. This is kind of entering the mainstream, and so I think that is validation that I was onto something. When I started to talk about this about a year ago, Mar-a-Lago Accord is kind of where this is leading to. It didn't have a name when I first kind of was formulating this framework. It didn't even have a name yet, and I was just kind of calling it a reordering. But it increasingly appears like we are headed for one of these. So I think it's really critical for people to understand the way that all these things work. I mean, we all use the dollar, but many kind of normal everyday people don't really understand how the dollar works, what the dollar even is. So hopefully this will be helpful in not only kind of where we've come from and what history has to show us, but also where we are headed. Okay, so the dollar after World War II, we were living in this system where the dollar was fixed in value to an amount of gold. $1 got you X amount of gold. So this was gold backing. The dollar was backed by gold. This was the Bretton Woods system. Now, private individuals were not allowed to own gold. That was outlawed by Executive Order 6102. This was mainly in regard to foreigners, foreign governments, foreign countries. And this was called the Bretton Woods system. And what was happening, where Triffin comes into play, he was a Belgian-American economist who kind of warned about all the things that we've seen over the past few decades, a very prescient guy. It was following this World War II kind of Bretton Woods era, right? What we saw was because of the Marshall Plan, because of Americans buying foreign goods, the Marshall Plan was a huge kind of export of dollars out into the rest of the world. Well, we were not increasing our gold reserves during this time. And so what he kind of first sounded the alarm on was what he called this dollar glut. And glut refers to an overabundance. So there was an overabundance of printed paper dollars, but not enough gold that was supposed to back them. And we can actually see that here in this chart. I will link to all of these. This is from the NBER. I will link to all these papers that we'll go through in the description. Here in red, we see the gold reserves. Remember, this is what is backing the dollar at the time. We can see it peaked in 1948. Well, blue shows the liabilities. Remember, every dollar is a liability for the US government, for the Federal Reserve, for us as a nation. The dollar is actually a liability, technically speaking. And what we can see is that the amount of gold that was actually backing the dollar was decline. Meanwhile, the liabilities, right, the paper dollars, which represented a claim on the gold, those were increasing, right? And so when Triffin gave his address to Congress was 1960, seen right here. This line also, or this chart also shows gold versus U.S. liabilities to the rest of the world. But basically, what was happening is we also had the Vietnam War, which was extremely expensive. Um, and we didn't have enough gold to actually finance it, right? And so basically, what started to happen is as the rest of the world started to demand their gold, for convert the dollars that they had for gold. it led to an outflow of gold, right? Which we see here, this red line, or this red line, an outflow of gold. While at the same time, because of the Marshall Plan and because of the dollar spreading as reserve currency, the amount of claims on that kind of ever smaller amount of gold, the claims on that ever smaller amount of gold were actually increasing. And so, famously, France sent a warship, right? Basically called our bluff that we didn't have, that the dollar was not worth what we said it was because we didn't actually have enough gold for the amount of paper claims that we had on the gold. Um, Sent a warship to New York Harbor to demand their gold back. Well, this is when 1971 Nixon shock. This was when President Richard Nixon removed us from this gold convertibility. And here in white, we see the DXY index. This is the dollar index as measured versus other fiat currencies. And we can see what happened. The dollar fell pretty sharply versus other fiat currencies. Well, what really matters is what happened with the price of gold. Now, remember, here in 1968, gold was $35 an ounce, and it was just a shiny rock. Here, after the gold standard was after the Nixon shock, gold was at $180 per ounce. It was still just a shiny rock. And then here in 1980, gold was even higher at about $700 per ounce. And it was still just a shiny rock. What I'm trying to illustrate, gold did not get any more valuable. What this purple line shows is a collapse in the purchasing power of the dollar, right? The dollar got devalued. Gold is a fixed real thing. And the amount of dollars that you need to buy that fixed real thing went up really dramatically. I mean, from $35 to $700. This is the sort of thing you only see once in a generation. Well, I will point out, as I have been for a while, gold has been rising pretty sharply in this kind of post 2020 era. And remember, this purple line here is a logarithmic chart, meaning it adjusts for exponentials. When you see an exponential rise on a logarithmic chart, that is incredible. That is, it cannot be understated how big of a move that is. And we are starting to see kind of the early stages of what appears to be a dramatic rise in the value of gold, or put another way, a dramatic collapse in the purchasing power of the dollar. So gold is I think one of the measuring sticks that we can use when we look at all this stuff. So not only that, but we remove the gold convertibility, right? The dollar falls versus other fiat. It also falls very sharply versus gold during this time. Well, what happens in the early 80s? The US economy comes out of the kind of malaise it had been in, high inflation, stagflation. We had higher nominal growth. We had higher interest rates. There was also supply side issues, right? The oil shock I noted here. And the dollar, right, due to the fact that the US was booming and we were offering high interest rates, capital flooded into the dollar. Well, what do we see happened with the DXY versus other fiat currencies? It went from 86 all the way up to 130 in a matter of a couple of years. Remember, that might sound good, but there are two sides to that. That also means that, okay, yes, imports became much cheaper, but exports became much, much more expensive. And so this ultimately led to the Plaza Accord. This was when the U.S. turned into a debtor nation, and we will look at charts that show this. And we can see what happened. The Plaza Accord is basically a bunch of, the big countries get together, they revalue their currencies, and try to sort out some of the imbalances that are embedded there. And we can see the dollar weakened as measured versus other fiat currencies. And the other kind of thing I want to note with this particular DXY chart is when China was admitted into the World Trade Organization, we can see that was the last time that the dollar has ever traded up to like the 120 level. And sure enough, with this appreciation, what happened? We gave them most favored nation status, let them into the World Trade Organization. What do you know? The dollar weakened. This was also when the global savings glut starts. So we turned into a debtor nation with the Plaza Accord kind of around the mid 80s. And then here in kind of like the late 90s, early 2000s, there was the start of what Ben Bernanke, who is the chairman of the Federal Reserve, under Obama, termed the global savings glut. Again, this is an overabundance of dollars. They are not being invested in real things. They are just kind of accumulate. People are hoarding capital, right? Whether that's people, rich people in America or foreign central banks, right? There is an overabundance of savings, and it's not being put to good use. It's not being invested in people. It's not being invested in plant and equipment. And this goes to my silent depression video that I would highly recommend if you haven't seen that already. Interestingly, this is the period of time that everything seems to have changed. Was this late '90s, early 2000s, and that applies to kind of the collapse in standard of living here, at least in America. But this is when that started. Was kind of the early 2000s. And the last thing I want to point out here is while the DXY might show 2000 peak being much, much lower versus other fiat currencies here, as you can see, when you value the dollar on a purchasing power parity basis, you can see that we are even more grossly overvalued. This chart, it was measured in 2023 by the IMF, the International Monetary Fund, on a purchasing power parity basis. The dollar is even more overvalued today than it was either at the peak in 2000 or the peak in 1985 when we got the Plaza Accord. The other thing that I will just real quickly show, there's something called the impossible trinity. This is a law that states you cannot have all three of these things. You cannot have a fixed exchange rate, sovereign monetary policy, that think of independent Fed, and free capital flow. That'll come into play later in the video. So here is the balance of trade and the fiscal deficit. These are both a measure of a gap between two things. Balance of trade is the gap between the value of imports and the value of exports. The fiscal deficit is the gap between what the government spends and what it collects in revenue, tax receipts. And so what I want to point out here, in the dotted line of each color, right, white and yellow for each of them respectively, you can see what balance looks like, what a balanced trade balance looks like, and what a balanced fiscal account looks like. And what I want to point out is, here in 19 in the 80s here, I tried to come up there. There is a famous New York Times headline: "U.S. turns into debtor nation." That was in 1985, if memory serves. And remember, this was the Plaza Accord. We can see that dynamic that I had explained earlier, where as you have a strengthening dollar, it makes U.S. goods more and more uncompetitive. We can see that that was starting to take hold, right? We had run balanced trade. This goes back all the way to 1950. We had run balanced trade, even, surplus at moments, small deficit, but in general, we ran balanced trade. Well, what happened starting in the early 80s? Financialization, globalization, all these sorts of things took off. And we can see, because the dollar appreciated, we can see that this the balance of trade, right, started to widen as a deficit. We were importing far more than we were exporting. The dollar, famously, we established, right, was weakened following that Plaza Accord. We can see that that had a positive effect on the balance of trade. U.S. goods were finally competitive to be sold to the rest of the world, on and on. Well, another kind of point in time that I want to point out here is that when we ran a balanced budget, this was in the late '90s, and here we can see, as this yellow line is crossing, that is a fiscal surplus, meaning we are actually kind of saving money on a not national level. The other point to point out is 2001. So again, remember, this is when China was admitted into the World Trade Organization, and we can see the effect that that had on the delta, the gap, the difference between exports and imports. We can see the balance of trade widen significantly. Currently, the balance of trade stands at $140 billion per month. And the fiscal deficit, this is not the most recent data, fiscal deficit is running about $2 trillion per year. So if we are just to make it very simple, if we are buying $100 worth of stuff from the rest of the world, but we are only selling $10 worth of our own stuff, we have to be able to finance that gap somehow, right? All these other countries need to get paid. So how do we do that? Well, One of the ways we do that is by issuing debt. And this is why the fiscal deficit and the trade balance are so tightly correlated. Um, this is the dollar's reserve status. When people talk about that, what they're really talking about is US Treasury bonds. Remember, a dollar is basically a Treasury bond with no maturity and no interest, instant maturity, no interest. They're really talking about Treasury bonds. And so, how do we get them Treasury bonds? Well, we run deficits. And sure enough, you can see what has happened since we ran that balanced budget or that budget surplus. The deficit has widened significantly. Well, it's actually even worse than this. So these two were the nominal figures, right, for each of those. And what I want to show now is as a share of GDP. So this is the trade balance as a share of GDP. And then this is the fiscal deficit as a share of GDP. And again, dotted line shows balance. And a couple of things worth pointing out here. So we had established when we ran that balanced budget, right? Well, actually, about a budget surplus here in the late '90s, we can see that the fiscal deficit as a share of GDP, turned positive. What effect did that have on the dollar? So the dollar appreciated significantly during that time period, and we can see that peak here as the dollar appreciated. Right, we were becoming more fiscally strong, right, healthy as a government. The dollar appreciated. Well, what did that do to the trade balance as a share of GDP? It absolutely blew out the trade deficit, right? And so this is one of those kind of things that stands where there's a dilemma that the country faces, which is you must run ever increasing deficits. Because if you don't, if you even try to behave responsibly and run a balanced budget or a surplus, even your currency will appreciate so much that it blows out your trade deficit, and it just kind of keeps going, right? So they become these kind of self-perpetuating things. And here in red is the debt. So I had mentioned one of the ways we come up with the difference between the stuff we're buying from the rest of the world and what we're selling the rest of the world. One of the ways we come up with that is by issuing debt. And so there are real consequences. I should mention, the debt will always be repaid. There will never be a nominal default. But I do expect that the government debt, the treasury debt, must be devalued in real terms. This goes back to what we were talking about with gold following the Nixon shock. Something like this, where the debt is devalued against real scarce objects, real scarce items. Because these twin deficits seen in green and blue, and the government debt seen in red, which I've done other videos on if you want more in-depth kind of debt analysis, fiscal analysis, these trends are not sustainable. And they are kind of coming to a breaking point, just as Robert Triffin, warned Congress or tried to warn Congress in 1960. And so here is the current account. So it's important to note the current account and the trade balance are very closely linked. In fact, I'll throw the nominal trade balance there, and you can see that is essentially the same line as the current account, the same shape. The difference here is that the current account includes other minor components. The balance of trade is only goods and services, and the difference between imports of goods and services versus exports of goods and services. That is what the balance of trade measures. Well, the current account starts to include other components. They are very minor, but that's what the current account is. The current account is one of the two main accounts in international finance and accounting. And so what I want to point out here in purple is that same DXY index. And what we can see is that for, going back to that early 80s period, remember the dollar appreciated strongly. And part of the reason I had mentioned for that was rising rates, right? Global capital flowed into the dollar because you could get higher interest rates here in America, more return on your capital. Since the early 80s, interest rates have been falling. So running a current account, right, in deficit and financing it with debt can work because the cost of that debt is falling. Well, what I want to point out is this clear trend change here that we see where the cost of debt is breaking out significantly to the upside, just as our current account is blowing out. This current account is measured quarterly, so $300 billion per quarter. That works out to about $100 billion per month. Um, and so we are reaching this kind of uh, decision point where the cost of the debt has been falling. So it has allowed us to accumulate huge and huge and huge amounts of debt to finance this current account deficit, to finance this trade deficit. But what happens when the cost of that debt starts to increase? That is clearly what we're seeing here. But also, I want to point out, see, as the dollar strengthened here from that kind of late 70s, early 80s, as the dollar strengthened here, the current account deficit widened, right? And the same thing is true here in the mid to late 90s. As that dollar was appreciating versus other fiat currencies, the current account deficit was widening. And now the reason that the dollar weakened and the current account deficit widened, was China's admission into the World Trade Organization. But then we can see that, some of that weaker dollar that we got here, right, led to the current account improving. So hopefully that relationship is clear. Again, there's a small lag before it's reflected in the current account, but that concept is super important. So here's a paper written by a governor of the People's Bank of China in 2009. This was the height of the GFC, and the global economy was in turmoil. He pointed out that a huge driver in the cause of the 2008 GFC was this Triffin dilemma, was this reserve currency status of the dollar. Famously, he said, issuing countries of reserve currencies are constantly confronted with the dilemma between achieving their domestic monetary policy goals and meeting other countries' demands for their reserve currency. On the one hand, the monetary authorities cannot simply focus on domestic goals, right, on U.S. Needs without carrying out their international responsibilities. But on the other hand, they cannot pursue different domestic and international objectives at the same time. These are in conflict with each other because they are the reserve currency issuer of the world. This he names Triffin Dilemma. Specifically, and in this paper, he argues for a move away from the dollar as the global reserve currency and towards something. There have been a number of kind of suggestions like Bancor, and this was kind of the purpose of this paper, which I will link to. This has been a dynamic that has been appreciated and kind of warned about for a long time. Well, so here's the capital account surplus. Here is the other side of a current account deficit, right? A current account deficit, this is the current account deficit here. The other side to that is a capital account surplus. I'm super glad people are finally talking about this because this is a huge structural driver of so many things: asset returns in nominal terms, asset bubbles, right? And the overvaluation of stocks and real estate and all these things. This is super, super, super important. And I've done a lot of work on this for the past year or so. And I want to, point out a couple things. So remember, the current account deficit, you just invert that, and this is the money flowing into our financial assets, right? Because everything must balance. We must come up with the money somehow. So by issuing debt, right, and money flows into the country to buy our debt, or money is flowing into our country to buy Nvidia stock at a 50 price to earnings ratio, or single family homes to outbid some young family. It doesn't really matter in terms of these accounts, the capital account and the current account. They must balance out at the end of the day. So current account deficit is a capital account surplus just by definition. So here's the S&P 500 divided by GDP. So S&P 500 as a share of GDP, you can see how tightly that is correlated. Here's the S&P 500 on a nominal basis. You can see how tightly that is correlated. Clearly, there was the kind of overvaluation of stocks with the dot-com bubble, but that's that. Here's corporate profits, which again have followed the trade deficit higher. So as our trade deficit widens, multinational corporations do better and better, and their margins increase. Here's the home affordability. This is the median sales price of a U.S. home divided by the median family income. And I marked in yellow here, this is QE2 and QE3. This is why they diverge here and why they ultimately come back. This was when the Federal Reserve was engaged in quantitative easing by printing money to buy financial assets like US Treasury bonds, mortgage backed securities. I will point out the Fed still to this day owns $2 trillion of mortgage backed securities. If they really cared about the fact that young families cannot afford homes, they would take that down to zero. The reality is that they don't care. But regardless, I think it's important to remind people that the Fed still owns $2 trillion of mortgage backed securities. And we can see the effect that that had. It diverged from this capital account surplus for a brief period of time before returning during quantitative tightening. And again, here's the net worth of the top 1%. As the current account deficit gets worse, as our trade balance gets worse, our trade deficit gets worse, more money must flow into financial assets. Who holds all the financial assets? The top 1%. Again, quantitative easing, QE2 and QE3 in 2012 and 2013. The net worth of the top 1% kind of took off. Quantitative easing is really, really good for that top 1%. Well, there is an inherent kind of issue with this, which is what's called the net international investment position. And you can see that this tracks with the current account that we were looking at here, right? The net international investment position as a share of GDP tracks the same exact shape as the current account. The reason for this is demonstrating how much do foreigners own of our assets versus how much do we own of their assets. And you can see that we have it has gone, parabolic or exponential in the wrong direction. This means that 100%, recent data, 100% of GDP, negative 100% of GDP is how much foreigners own of our stuff. Here is another way to visualize that. Here's the net international investment position, equity versus debt relative to GDP. And again, look at what has happened since, for the past couple decades, but certainly the past decade. We have just accumulated hugely negative net international investment positions, meaning the rest of the world owns America. They own our corporate bonds, they own our real estate, they own everything. They own equities, right? This capital account surplus is $300 billion per quarter. $100 billion per month must flow into US financial assets. You do this long enough, right? This chart goes back to the mid 80s. You run this strategy long enough, you end up where the rest of the world owns you. So it's a national security imperative. And here we can see the effect that the strengthening dollar had, right? By trying to run a balanced fiscal budget, strengthen the dollar, blew out the current account deficit. And then as the dollar weakened here, we can see the current account improved meaningfully. But as a share of GDP, we can see the fiscal deficit has been doing nothing but worsening. But we went from a balanced budget here, balanced fiscal budget here, to now we are running a pro-cyclical, right? Full employment, no war, 6% GDP deficit, and this goes back 4 or 5 years. This is not something that just changed yesterday. This is something that has been a long-term trend, and especially going back to say 2020 or 2021, right? There was a crisis and we needed to run a deficit, some would argue. But then the problem was we just kept printing money. We just kept running huge deficits and we never tried to actually improve things. And, normally what happens in a recession, here's 2008, this blue line, which is the fiscal deficit, it widens, right? We have to run a large fiscal deficit to try to stimulate our way out of the recession, but then we fix it. The goal is you come out of the recession or the war or whatever it is, and you end up addressing that deficit that you had accumulated, right? We can see that is what has happened before. The problem is we are kind of the ceiling, right? We keep our quote unquote improvement of the fiscal deficit each successive time is at a lower level, at a worse level. So yeah, there's a deficit. But then, we bring it back, but it's not quite to where it was before the crisis. Another crisis hits. We might somewhat improve the fiscal deficit, but it is nowhere near what it was before the crisis. So what effect does Triffin's dilemma have? What he warned would happen not only the stuff we've talked about so far, but he also warned this will hollow out your country. So we mentioned the national security implications of the rest of the world owning all of these financial assets of ours, debt, corporate bonds, equities, real estate. Well, they also hollow out your industrial base. And so, we've gotten into a position where 65% of active pharmaceutical ingredients come from the rest of the world. We've gotten into a place where, a huge amount of computer chips and electronic devices, which, by the way, go into everything nowadays, come from overseas, right? We couldn't get gloves and masks to protect our healthcare workers because we don't make any of that stuff anymore. We're losing a proxy war to a country with 1/12 of our GDP. It is because of this. Now, this might look great, right? GDP, this is the output, the gross domestic product that comes from the manufacturing sector. Well, once you look at it as a share of total GDP, it's a much different picture. Here in 2000, and this only goes back to 2005, by the way. It's much worse if you go back to like the early to mid 1900s. But we can see that even just in the past 20 years, our manufacturing as a share of GDP has decreased from 13% to 10%. So, like, this is just the past 20 years. Here, we will look at labor. So, this data goes further back. This goes all the way back to 1939. This is the total manufacturing employment in white here. And I marked two points in time, the end of the gold standard here in 71, as well as China shock, which was admission into the WTO. But what I think really illustrates the point is total manufacturing employees as a share of the total labor force. At one time, here in the peak of 1953, 26% of manufacturing of total employment in America was manufacturing. That number is now 7%. And so we can see the effect that the China shock had. We can see the effect that, after the gold, this was basically range bound up until the end of the gold standard. There are a number of things to point out here. A lot of people always mention technology and productivity, and this is a driver of decreasing employment, which I 100% agree that is a component of it. And so let's look at that. Here is manufacturing output in real terms in red. It's a index. It is not a dollar amount. And then here is the manufacturing unit labor cost. And the way that this white line is calculated is you take the nominal wage that is necessary to produce one unit of real output, and you divide it by that real output. So you are taking a nominal wage and dividing it by a real output. And what do we see? Not only since China shock has manufacturing output basically gone sideways. I mean, if you look at this going back to like the 20s or 30s, we had been growing at this rate that you see in the early part of the chart. We'd been doing that for the past like 3 or 4 or 5 decades. And then the China shock happens in '01, and we just kind of go sideways. Well, part of what's going on here is this unit labor cost has exploded higher, right? From, call it 86 in 2010 following the GFC, all the way to 130. That is a significant increase. I'll measure it right here. That is a 53% increase. So I decided to try to drill down onto this particular issue a little more. Here's the wages of manufacturing employees divided by the manufacturing unit labor costs. And this comes out with something very similar to the output in real terms. And then in blue, that unit labor cost, which again is a nominal labor cost divided by the real purchasing power, the real output of that unit labor cost. And one of the ways we can look at this is by looking at labor productivity in manufacturing. And what have we seen? Since China shock, which was here, um, labor productivity in the manufacturing sector has declined, right? As the unit labor cost has increased, meaning the nominal wage that it takes to produce the same real thing is increasing, productivity is decreasing. Anything below this white line is negative productivity growth. You can see that going back to 1988, we had decent labor productivity growth between 2, 4, 5, 6, even 6, 7%. Well, what happened during the China shock. That was the peak in labor productivity for manufacturing has been declining ever since. And also here in blue, I to just try to look at this a little closer, I took the unit labor cost for manufacturing and divided that by the unit labor cost for business. And it actually shows that the unit labor cost is increasing faster, right? The unit labor cost for business is increasing for sure, but the unit labor cost for manufacturing is actually increasing faster. And when did it set its bottom? 2008. There's a paper here by the BLS, the Bureau of Labor and Statistics, that goes into this labor unit cost and productivity more, that I would recommend reading here. I will link it in the description. But what I wanted to show, I think the point to really drive home here is this: what this does, what this chart shows, is a ratio. It's a relative chart. They take the labor productivity of foreign competitors, they divide that by the labor productivity of the U.S. So remember, with these relative charts, what that means is as the line goes up, that means that the competitors' labor productivity is growing faster than the U.S. If we all grew at the same rate, it would just be a horizontal line here at 1. But what we can see is that, Europe G4, I think that's France, Great Britain, Italy, and Germany, Japan, all growing manufacturing and labor productivity faster than the U.S. And so if people are interested, I would recommend this paper. There's clearly other issues going on with healthcare costs in America, the cost of labor here in America, the fact that wages have come nowhere close to keeping up with the actual cost of living, all these sorts of issues. Uh, Labor productivity is kind of like a whole other video to subject, so I won't go super in depth in this video. But suffice it to say, I think this chart shows somewhat of this sort of issue, illustrates it quite well. So here are durable goods. This is new orders for durable goods, new orders for consumer goods, and then new orders for capital goods. So capital goods, this shows like machinery and kind of intermediate components that are needed for further kind of manufacturing, right? Whereas a durable good is like a car, a washing machine, something like that. A consumer good is more of a consumption sort of thing. Like you can think clothing, apparel, that kind of thing. And what we can see is that this chart goes back to '93. Durable goods and consumer goods have grown. Once you adjust for GDP, it's a different story. But generally, this is up in nominal terms. This is both of those categories are up. Well, what has lagged behind? If you look at capital goods, going back to, I mean, really the early 2000s, which again is that silent depression kind of framework that I did a video on. The past 25 years, you can see that capital goods, new orders for capital goods are basically flat, haven't gone anywhere. This indicates, I think, this dynamic of the falling productivity that we see as measured here, this falling productivity, and again the Triffin dilemma, saving glut of all this money, that is all this wealth and money that is being accumulated not just by the wealthy here in America but all over the world, and it's not going into productive things. It's not invested in people, in real healthy wage gains. It's not invested in plant and equipment. It's not being invested, it's just being hoarded. And so here is the Dow Jones Industrial Average. And I picked the Dow Jones. I understand it includes stocks that are not industrial, but generally speaking, it's a much better measure of industrials than, say, the S&P or certainly the NASDAQ. And so what I did is, here's the Dow Jones. And we can see going back to 1985, it looks great, right? The industrial components of American economy are doing great. Look, that's up and to the right. Well, once you divide it by the NASDAQ, which is tech stocks, you can see what has been happening here in America. Going back to this data, the Nasdaq only started in the 80s, but we can see the precipitous decline that industrial. Again, I understand Dow Jones has some non-industrial stocks, but in general, this is a good way to measure. Uh, the performance, the financial performance of the Dow Jones Industrial as a financial vehicle has even underperformed the Nasdaq. Right? Everyone is just flooding into Mag 7. We see these trillion-dollar companies, these tech stocks that are going to change the world with their fancy services and lines of code, right? And we see this is a reflection of the underinvestment in industrials, in materials companies, right? This is what that red line is measuring. Put another way, this is the over investment in tech. And here is a really, really kind of clear way to illustrate this. Unfortunately, XLI and XLK only go back to the late 90s. XLI is industrials, right? And XLK is tech. And these are just industrials and just tech. So it's kind of a better measure than Dow Jones divided by Nasdaq. But what I wanted to point out is, following kind of China's admission into the World Trade Organization, this hit kind of this like triple top here, and it has just been declining ever since. And this very kind of explicitly shows this lack of investment financially in industrials material. This looks the same if you look at material stocks divided by technology stocks. And so anyways, so this, if someone is trying to make money off of a once in a generation sort of thing, one thing you could possibly look at is, okay, well, if we're going to pivot towards material stocks and industrials here in America, we actually make stuff here again. Well, a pair trade of long industrial, short tech comes to mind. Now, of course, there's also the Mar-a-Lago Accord, and we know that what happens to the value of the real purchasing power value during these sort of once in a generation events. It collapses, right? This is why gold went from $35 an ounce all the way to $700 an ounce in a matter of like 9 years. These now, I will say, gold has been pricing this in. People just aren't aware of it, but gold has been pricing this in for years now. This is not a something that started a couple months ago. This has been going on, right? Gold has been ripping higher for 2 years now, from kind of 1700 all the way up to 3300. This is pricing in the future, right? Remember, markets are forward-looking instruments. They are tools to discount the future. What the gold price has been indicating is it is pricing in, marking to market the real value of the dollar. In my opinion, I can do a whole video on the Mar-a-Lago Accord because I've been doing so much work on it for the past, I don't know, year and a half, certainly year. If people are interested, I can do that. But my general kind of framework for this is all fiat currencies, all developed countries have way too much debt. Everyone is way too levered. So all fiat currencies, no one really knows, but if I had to guess, all fiat currencies will be devalued in real terms. So gold and things like gold and Bitcoin will just do what they did back after the Nixon shock. They will go to insane levels. Everything needs to be devalued. All fiat currencies need to be devalued in real terms. But the problem is the structural overvaluation of the dollar. That's what the Mar-a-Lago Accord seeks to address. It is this overvaluation of the dollar, right? That is actually now even more overvalued than the peak of 2000 when we let China in the World Trade Organization, or 1985, which famously brought about with it the Plaza Accord. We are even more overvalued now. It's become a national security issue, right? Not only does the rest of the world own us, but we can't even make like critical things that our people need to survive, let alone to defend ourselves. God forbid we were ever attacked. And so what I think is all currencies will be devalued, but some currencies will be devalued more, right? And so if you devalue, say, the Chinese yuan and the dollar, but you devalue the dollar by more, what you effectively did was changed the FX exchange rate, right? You effectively changed the exchange rate of the currencies. The dollar's too strong. Put another way, the Chinese yuan is too weak. They have been talking for many years about restructuring their economy away from this overcapacity export dumping subsidized export model towards more domestic consumption. They themselves have been saying that for many years now. Now you're at a point where kind of the U.S. is going, okay, yeah, we got to reorient our economy as well. I think that all of these dynamics they just inevitably occur with a Mar-a-Lago Accord. I think everything gets devalued against real in real terms. Everyone is too overlevered, and then some fiat currencies will be devalued more than others. And by doing that, you will set a new exchange rate that is much more fair. Because remember, the dollar is grossly overvalued, but put another way, the yen is too weak. The yuan is too weak, right? These other currencies are also there's two sides to that coin, um, and it will restructure the not only our economy but kind of the global financial system if China moves away from an export driven subsidized export driven model and more towards domestic consumption, and the US starts producing things. I know it sounds crazy, but we start actually making things here in America. That is a total reshaping of the global economy. You only see this once in a generation. So hopefully this was helpful. I know it's a lot. I would also say that the other a piece of this that never seems to get mentioned in the mainstream media, Bloomberg themselves mentioned that for an Apple assembly technician, right, just a technician, not an engineer, not a supervisor, just a technician, the starting salary for that U.S. based assembly technician was $115,000 per year. So these are not low paying jobs we're talking about. These are high value add, high paying, good jobs like we used to have when America was kind of in its heyday. These were the sort of jobs that only one parent needed to work, and I think there is a potential for a decade down the line us to return to that sort of kind of vision of what America could be, not where both spouses need a C-suite level position and they got to have two or three side hustles, and then maybe they can struggle and barely afford a mortgage. No, I think real high-paying jobs addressing the silent depression, real wage gains for the bottom 90%. Yes, this will be horrible for capital markets, but they've we know how well they've done. They have done exceedingly well via this structural bid into their financial assets. So I think this is kind of the direction things are going, not just on the domestic political side with that kind of populism I was just talking about, real wage gains for the bottom 90, but also just kind of globally. So, anyways, hopefully that was helpful. I know it's a lot. Again, check out my X. I've been talking about all of these dynamics for like at least a year and a half. And I have some pretty thorough articles there. Anyways, catch you in the next one.